Good day, YouTube. This is Jay Money with Falling Forward Financial. Just come across this dividend buy. I wanted to see who out there has this one. I've heard about this one a couple times. Don't currently own any shares of this one, but this is a dominant dividend stock, and I'm going to go over if it's a buy or not. So SONOMA generated a healthy net revenue and earnings growth into the first quarter. The specialty retailer's dividend payout ratio gives it plenty of room to grow. The stock is currently valued at a meaningfully discount and industry average. So, the kitchen and home furnishings retailer is a reliable dividend stock. So just throughout the last 2 years, especially 2 years right in the midst of the pandemic, everybody's staying home and started looking around and, oh, that needs redone, this needs redone. Kitchen and bathrooms are always the first ones to be redone, so it's not an understatement to say the major volatility has returned to the financial markets in 2022. For the first time since 2020, economic and geopolitical worries explain why the S&P 500 index has dipped 19% year to date, so the market volatility may be unsettling to investors in the short term, but it is leading to great buying opportunities for the long run, as the specialty retailer Williams-Sonoma, or WSM, is one high-quality company that long-term investors might want to consider. But is the stock a buy for investors seeking growing dividend income? So let's go ahead and take a look. But here is their chart. So just about a month ago, looks like it was in the 126, 127 range. Looks like it took a dip here to about 117, 116, dropped about $10, ran back up to where it was, fell back even more to about the 113, 112 range, and currently at 119.98. So $8 billion market cap, days range of 118.71 to 125.21, so you get about a $7 swing in there. 52-week range of 101.58 to 223.32. And not a whole lot of volume on this one, average of about 1.7. So impressive growth continued in the first quarter. Williams-Sonoma reported net revenue and non-GAAP adjusted diluted earnings per share for the first quarter ended on May 1st. Company recorded $1.9 billion in net revenue during the quarter, up 8.1% over a year ago period. The comfortably topped analysts average net revenue forecast of $1.8 billion for the quarter. How did Williams-Sonoma exceed the consensus in the first quarter and the ninth quarter out of the last 10? It was thanks to a 9.5% comparable brand revenue growth. Williams-Sonoma Pottery Barn and West Elm brands both saw double-digit growth. This was partially offset by the low single-digit revenue declines in Pottery Barn Kids and Teen and the eponymous Williams-Sonoma brand. Had a high bar to clear compared to a year ago period when the Revenue American Rescue Plan was signed into law. It's because consumers had more discretionary income in the prior year from the economic stimulus, yet the company still managed to grow its net revenue, demonstrating the power of Williams-Sonoma brand. So if you have their stock or have used any of their products, you can list that in the comments. And the company posted $3.50 in adjusted diluted EPS in the first quarter, which was good enough for a 20.7 year-over-year growth rate. That was significantly higher than the average analyst adjusted diluted EPS prediction of $2.90 for the quarter. Represented a 10th quarter out of the past 10 quarters that Williams-Sonoma surpassed analyst adjusted diluted EPS consensus. It was achieved for two factors. Their net margin expanded by 40 basis points over the year end period to 13.4 during the first quarter. Second, the company's diluted outstanding share counted declined 7.4% year over year, 72.7 million in the quarter. Even with a potential recession on the horizon, analysts are still expecting 4.7% annual earnings growth over the next 5 years for Williams-Sonoma. The dividend is also very secure, so yields a market-beating 2.5%, which is meaningfully higher than the S&P 500 index 1.6% yield, and income investors can sleep well at night knowing that the stock's dividend is safe. So it has a payout ratio is projected to be 19% in 2022. This gives it a huge margin of safety for growth. Its dividend through most recessions while also reinvesting in the business. Stock's low payout ratio is why I believe Williams-Sonoma will be able to deliver high single-digit annual dividend growth in years ahead. So again, a wonderful business at a steep discount. Forward PE ratio of 7.7, much lower than the apparel, accessories, luxury goods, and average multiple of 10.2. That's why investors would be wise to consider buying the stock now. So, but found this one was kind of interesting. Like I said, I don't currently have any shares of it. Like I said, if you have any shares of this one, go ahead and list it in the comments, along with your cost basis, any other information you'd like to share on this one. And if there's any other dividend stocks out there you want me to take a look at, I'd be happy to do that as well. But here you can kind of see some of the action going on with it. 123 down to 122, hit a spike. So I suppose you could even trade this one if you wanted to. But you can kind of see the action over the last year, and the 150s ran up to the 218s last fall, and it's just been coming down like everything else since then. So they have the following segments: Pottery Barn, West Elms, Williams-Sonoma, Pottery Barn Kids, and so on. Founded in 1956, and there's your 2.26 dividend yield. 44% hold on this one, and here's a look at their last earnings. Next is expected on August 24th after hours. So, but that's all that I have on Williams-Sonoma. Like I said, if you have this one, listed in the comments, along with your cost basis, any other information you'd like to share on this one. And if you haven't smashed that like button yet, go ahead and hit that for me, as well as subscribing and hit the bell so you're notified when the next videos drop. Again, this is Jade Money, following Forward Financial. Happy trading, happy investing, stay green. Cheers.